Welcome to the Ideal Investor Show. This is the podcast where we help you challenge your mindset and discover where you are. Tired of stories about other people's success? We can help you change your life, determine your time freedom point, and join us on the journey to financial success. Let's go. Hello and welcome to another episode of the Ideal Investor Show, where we bring you great guests, people who are experienced in real estate and have their different approaches to ours in how they go about it, what they have learned, and what they can share with us. And today we have Darin Davis. Welcome, Darin.
How you doing? Thank you for having me today.
Thanks for making time for us. For our audience, just to tell you a little bit, it's really kind of very apropos or very on time or whatever we want to call it, because some of our tribe members have been involved, myself included, in a syndication project to build a large apartment complex in Austin, and you are in Austin. But before we get into that, Darin, tell us a little bit, how did Darin Davis get to what he's doing today?
Sure. Well, I'll tell you what, probably like a lot of folks, I had this epiphany, and I was in San Francisco, and my wife and I were just saying, we are traveling a lot. We were in software, both of us were. We were just work. And we said, we need to kind of get control of our lives because we were being controlled by our companies. We literally heard a radio show one day that talked a little bit about real estate, and we just got mesmerized by it. Next thing I know, we both quit, started studying. And back then it was books on tape. There was no podcast, no internet, there was nothing. So, and we were just self-taught, and we decided to take a leap of faith. And, we had enough experience and we had enough money, we thought at the time, but we didn't have cash flow. And we'll probably talk about that some part of the day, but right. We quickly had to just execute. And we decided that we were both from Texas, and we decided that, if we're going to get married, have kids, we want to do that back in Texas. So we moved back to Texas in 2001 and just kind of started doing a family and friends thing. And it's the best thing we ever did by far. So that was what, 23 years ago. We just wanted control of our lives, bottom line.
And when you say the family and friends thing, can you expand a little what you mean by that?
Well, the first time I heard the word syndication, I thought it was like a mafia movie. So I didn't know what it was. And I was going, ooh, I'm going to be a syndicator. When you're first starting something, you end up calling your mom and your dad, and you call your brother, and you call your college buddies. And I got people investing 10 grand, and, but it all worked. And I was deeply committed to their success, more so probably than mine. And that commitment and that constant communications and the constant work and the constant learning. We were successful on a bunch of small little syndications. And then I started having people call me, say, hey, I want to do this. By 2008 or 9, it had kind of turned in from a just us investing more as a personal thing. And I call it a hobby. It wasn't a hobby, but it wasn't a job at all. We ended up saying, you know what, this is getting bigger than we thought. And now we have 50 people that want to invest with us. But it took us 4 or 5 years to get there. 4 or 5 projects. And then all of a sudden we had a true syndication model. And that's really when it started. It was like 2008, 2009. And for any of us guys on this podcast that have a little bit of gray hair, you know that 2008 or 9 was not the best year to start a real estate syndication group. But we started it. We were fortunate that we pushed through, and that's where we are today. 15 years later, we're still cooking.
That's very cool. Now, one syndication investment that little group out of our larger group of clients did together, and myself is also involved in it, is in Austin. But one of the things that is not always so really clear is, and I'm kind of curious based on what you were just describing, when you first started, or when you started setting it up and it went from friends and family to involving other people that you weren't somehow related to, how does the limited partner and the general partner, well, limited partner is obviously getting paid out of the results or profits or gains or whatever you want to call it. But for a general partner, when you and your wife started, how did you sustain yourself? How did you get paid?
Well, that's a real good question. As I mentioned about us leaving our jobs in San Francisco, we were both highly compensated, and we had built up enough money to actually live on for a few years. And the thing that was happening to us is people were asking us, how much money do you have in the deal?
Right.
And I had to build credibility by doing that. And it wasn't like I had $50,000 for each deal to do, or 100, but we had to put in 25 to 50 per deal. It was lean, I will tell you, because we didn't have second jobs and times were very lean, but I think it helped accelerate our growth because we were so committed to it, because we were so committed to not having control of our life at the time. And we were a little bit older. I was late 30s, wife was early 30s. So we weren't, we had been in the workforce for a while. We had enough knowledge on what we needed and a budget and all that. The first few deals we did not take a lot of compensation on the front end at all.
Yeah, that's good to know. Now, the other part leading to the bigger things that you're doing these days would be to think about, or at least ask you, did you right off the bat have to only look for accredited investors, or did you start out where you could take in more regular people?
Truthfully, I didn't even hardly know what a accredited investor was. So my vetting process in 2005, 6, 7, 8 was probably not the best. Okay. But
Yeah.
once we started that syndication group, my attorney said, okay, you're starting to play like a big boy. You're starting to take in real money. This is not your mom and your aunt and your college buddy. You need to really start looking at this. And so we really formalized the syndication model, started really understanding the accredited investor model. And at that time, I did have to turn away people that were my friends that wanted to do it. And I just said I couldn't do it. It was painful because, you need that extra 25 or 50 grand when you're first starting, but it's not worth the risk. It's truly not worth the risk. You have to go through that accreditation process. It's just, you got to hustle a little bit more. That's all it is. You've got to network a little bit more, hustle a little bit more. And today, I got to tell you, Axel, compared to 2007, 8, 9, the ability to communicate with investors is 100-fold from what I had to do. I almost think I was still using Yellow Pages, if anybody knows what Yellow Pages are. At least I had a cell phone, I think. It was not easy. It was a lot of hustle, and there's a lot of opportunity. So the accredited investors are out there, and there's a lot of education on both the syndicator side and the accredited investor side. So I think it's far easier today, especially if you've got just even a small track record.
And maybe just to finish on that one before we move to the next topic, is there something you can tell anybody who might also be interested, not just to be an investor, but maybe do something similar to you? How do you actually find accredited investors?
Quite frankly, ours has been word of mouth. We haven't done a lot of like direct marketing. We are starting to now, but we had literally got a referral off of a referral off of a referral. And we started doing social media only about 4 years ago, 5 years ago. But today we're starting to look at more targeted, because as an example, the accredited investor to me is probably somebody that's got a minimum net worth of $5 million. All right.
Yeah.
So the way the data sources are available for us today, we can identify profiles of potential investors that have between, 5 or 10 or 10 to 20 million, business owners, physicians, entrepreneurs, a lot like that. So we've started using some stuff on LinkedIn to better educate professionals who are literally, engineers, doctors, architects who are highly compensated, but they start to realize when they start hitting about age 50, they start going, wait a second, this time for money thing is starting to bother me now. So they're actively searching people out like you and me, people that have some experience, that have skin in the game, and that have a good track record.
Yeah, absolutely. And I think, what you offer and what we are offering at Idea West Grower is not that fundamentally different. It's just more a matter of the question of how much control does somebody really want to have. Right? If they work with us and we bring them into turnkey deals where they literally hold the deed, even though we recommend obviously to put the deeds in an LLC for all that protective stuff, but fundamentally anything that happens, the lender is working for them, the property management is working for them. I'm always saying, okay, you not really want to continue doing time for money, like you just said, Darren, but what you ultimately want to do is you want to really, at least in my opinion, be pretty much in charge of your portfolio of assets. Then it becomes a matter of, okay, do I work with Darren and let him and his general partner team basically do the work and the decision making, or do I want to straight out own the properties and have the decisions by telling property management what to do, or the lender what to do, or which insurance I want, and that kind of stuff.
Yeah, I get a lot of people that want to learn, and I tell especially some of the younger guys that are just now at an accredited investor status. I said, look, guys, I said the best education you can get if you want to learn this business. I said, take 25 grand, take 50 grand, and put 50 with this operator, 50 with this operator, and 50 with this, and watch how they run the business. Watch how they run the investment. Look at their property management, their assets, and I mean, track everything they do. You're going to get an under the hood look at 3 different companies. I can't think of a better education when you're trying to go from here to here in a quick at a short amount of time, because I didn't have that opportunity. I literally did not have access. I had one guy, and that one guy let me come into one of his deals as like this tiny investor. And if it hadn't have been for him, and he was the only mentor that I had for like 4 years before I understood what was really going on out there. But it was the best thing that I ever did. Did I make a lot of money with him? Not a lot. Did I lose money? No. Did I get a great education? Absolutely. So I would tell people, find some, more tenured sponsors, and you've got to take that first step. You just can't sit there and wait, because your education is going to cost you one way or the other.
Yeah, absolutely. I'm totally with you. And I mean, I'm always using, and I don't know if it's an accepted or unaccepted definition, but for me, mentoring as a definition for what we do is basically taking all the experiences that I made in 15 years of investing by myself for my family and weeding out the stuff that works, combine it with the relationships that we build in the process. And then when anybody says, okay, can you help me as my mentor? Obviously, all the things that didn't work, you don't even have to try anymore. Right. So
No,
it's
no.
basically getting to a similar goal or maybe even beyond much faster, and by avoiding most of the things that I had to pay for, you probably had to pay for with either time or money or both.
Both, yeah. And I think you and I are a lot alike like this, because it was such a powerful and impactful thing to me and my family when we started seeing cash flow that was starting to support our life. I've got to go tell everybody about this. So I got to go preach. I've got a mentor. And am I doing as much as I want to in that area? No, but we on this podcast, yes. This is one of the, I thought this is a way I can get my message in out to people about the things you could be doing, should be doing, if you really want to get that cash flow lifestyle thing addressed.
Absolutely. And I think, I mean, for me, the mentoring was not originally the trigger. And, I didn't say, let
Yeah.
me start a mentoring business. The thing was that I, just like you just said, I kept telling, when they asked me, what are you up to? My answer was, oh, I'm in the process of finding another property in Illinois or in Idaho. And then, you meet the person 6 months or 12 months later, and they say, oh, by the way, how did this work out that you told me, like last time? And I said, well, it's fine. We own the property now. It makes us $250 a month or whatever the thing was at the time. And so slowly people were basically, can I do that too? And I
Yep.
remember my answer was always, yeah, sure, you can do that too. That's how this started.
Well, I tell you, somebody was asking me about where to go for education, and I mean, there's hundreds of places and mentors and all that, but I kind of stepped back and I go, you know what? I started looking. I said, I am still in the education. I mean, I'm still in the learning mode. Okay. I stepped back and I said, what am I doing for learning? And I'm averaging still to this day. Okay. And I'm 22, 23 years into this. To this day, I'm spending almost 6 figures, just under 6 figures a year on education.
Yeah.
And you would think I would know a lot. I do, but I don't, because it's changing constantly. And if you're not keeping up with it, or if you're not committed to it, what you learn today is gone tomorrow. So a guy was asking me, what do you do? And I said, well, I actually do still educate. So all I'll tell people is, here I am, 2 decades later, And I'm still looking for mentors, education, solutions, ideas. And you and I were talking about this earlier, kind of some of the ideas that we're looking at to really navigate through the next couple of years.
I think you and I, we would probably be becoming aware of certain new developments sooner than the average person because it's not necessarily in the mainstream media early on. But for example, I was probably one of the very first adopters of tokenized real estate. At the time when I just started, you could create a relationship literally with the founder of the company, right? And
Yeah.
so that educational component, I think, comes also from the fact that there's new technology. Then you read an article, the NAR just settled on the commissions. What's the impact going to be on that? And all kinds of stuff that's constantly changing. So yes, it's education, but I think it's also just in service of our clients to stay up with what's going on so we can really
Yeah.
serve them.
Well, and one of the reasons we're talking today is our environment. We have told our investors we see an opportunity right now that if you started investing in 2010, you probably have not had an opportunity to invest in what's called a preferred equity. And the reason why you didn't do preferred equity because you and I and everybody for the last decade plus have been doing common equity. You have the senior debt, which is your bank loan, and then your investors are your common equity, and those two have been the capital stack. Well, everybody's heard about lower leverage going from 80% down to 50, interest rates going from 3.5 to 8, valuations coming down, rents going flat. What's happening right now is that these developers are needing some rescue capital. They're needing some way to fill the gap because they've literally their interest reserves are gone from 3.5% to 8.5%. It just wiped it out, and delays and rents and all that. What's called pref equity is this sliver of money that comes in and helps out that project, but it's right behind the senior and it's in front of the common. So you don't get the upside that common equity would get, but you get a contracted return, and that money, in almost all cases, and for us at least, is paid to the pref equity, which would be our investment group, before the common equity receives anything or the sponsor receives any back end. I think the next 3 years, with all these loans maturing and interest rates still staying high for this year, and I think even significantly next year, there is so many loans that are coming due in the next 16, 18 months. I mean, billions of dollars. I think between 24 and 25, I think there's like 600 billion just in multifamily. And that's a lot of apartment complexes. And there's going to be a lot of developers that are going to say, hey, I need some help. We can no longer service the debt. We're willing to ride this out. And this pref equity is coming in and getting double-digit returns paid out quarterly, and they're getting repaid before the common equity does. So even in the event, let's say the property and the common equity, let's say it was, I don't know, 10 million. The common equity on the sales price is not fully recapitalized. That doesn't affect the pref equity. So the common equity may have to take a haircut, hope not. But this pref equity, if you're looking for something that is short term, that's 10, 11, 12% returns paid quarterly, and you've got all that common equity behind you, that is something that there's a lot of safety there. And we're only doing deals that we would actually want to own. We underwrite them. We underwrite them just like we're going to own them.
Right.
There's a story about that a little bit later, but that's something unique that a lot of people have not been exposed to over the last decade plus. But I think that window is, if you're looking for cash flow and a lot of safety and some good markets, that pref equity is an opportunity. And so if they haven't heard about it or seen it, it's worth looking up and understanding what pref equity is, preferred equity.
Yeah, absolutely. And I'm very grateful that you bring it up. You spoke about cash flow and cash. And so can you dive a little bit into that?
Yeah. I don't like cash sitting still. All right. Does that make some of my family members a little nervous? Yeah, it does. But seeing cash over there, and we saw what really bothers me, inflation over the last 2 years.
Right.
Your buying power just got crushed. Even if you were in just something that was a 5 or 6%, you may be neutral today, 3 years later. I tell people, people say all the time, cash is king, cash is king. Absolutely it is. Okay. But cash flow is a bigger king. All right. Because if I can have something that will cash flow 6, 7%, it's better than having just cash sitting over there. Now, I would never tell anybody to take all your cash and do that. But when somebody's got 40, 50% of their, I guess, reserves or, their money sitting in a cash account, do something with it. Maybe you need 10 or 15 or 20%. But when you start getting over that, then you're losing money by letting your cash sit there. I think for first time investors, I love the duplex, fourplex stuff. Love it. It is a nice, simple, safe way to start getting a small return, but it's such a great education and low risk. I think that's what I did. I mean, I literally started out with 3 Section 8 homes. That's what I started with. I mean, our apartment complexes now are 60 to 90 million. Yeah.
Well, I think that one of the important things, in my belief, and why I'm still doing this and help other people do it, is as soon as you get into the commercial side, right? Like, let's say 10 units, 20 units, 100 units, anything like that. In my opinion, is really a different and rightfully so-called commercial kind of environment, right? Where the whole way of how you actually determine valuations and what you need to do on improvements if you get something that exists and so forth. And you compare that to what most people are familiar with is some sort of either they grew up in a single family or maybe in a duplex or a small apartment unit or stuff, and to owning that and then have some property manager or management company running it for you, which is always my model. I think it's silly to try to do this yourself and think
I tried it myself and I failed. Don't do that. Yeah.
My biggest point is, and I mean, you and I can't really answer that question properly, but even if you take anybody who works in a reasonably good job and say, okay, fully burdened, what is an hour of your time worth? Right. And most people end up somewhere between 50 and $100. Then you go and say, okay, well, on your duplex that gets $2,000 rent a month, you're paying $190. So,
Yeah.
so
Yeah.
per month on the whole thing, at your own rate, you could get maybe 2 hours at the
Yeah.
maximum, and that would be forever, no more than 2 hours. You wouldn't want that. You want them to spend more time on that, right? So obviously the model doesn't work when you have to do it at your own rate, which is what most people want, right? But when you have 800 units and not every unit has something every month, okay, then it can be a business that might work. But if you have 1 or 2, it's just
Yeah.
not competitive.
Yeah, no, completely agree. So yeah, and I go back to the single family stuff and the duplexes and all that. If there was a guy on the radio years and years ago, and I think I'm in my 20s or 30s. His name was Bruce something. He was a financial real estate guy. He preached every Sunday afternoon. He had this radio show. He said every investor should buy a duplex by the time they're 25, live in one side, rent the other side. That was the way they got started back in the 80s and early 90s, And I've always thought about that. If I'd have ever done that, how fast would things have moved for me in my late 30s and 40s? Whole different
Yeah,
ballgame.
absolutely. I'm totally with you. I'm actually the same. If somebody has the ability that you live in a relatively well-performing area, you can do duplex, triplex, fourplex, buy it, live in one unit, renovate the other step by step, and then get the next one. It's such a leverage, such a deal. It's just the perfect model. The problem nowadays is that the people that have good jobs, so they can buy it and qualify, live in areas where the numbers don't work.
Yeah, that's very true. But I think also you just got to be resourceful, especially, I mean, back when I was starting, we didn't have all these resources here. If I'd have had even 1/10 of the resources that are out there today, no telling how fast I could have accelerated this with determination and grit. But
But this is actually a
it's out
great,
there.
it's a great circling back to where we started the conversation about continuous education and mentoring, because it's hard to imagine that somebody would just come up with the necessary information on their own. But if they just, for example, come to me and you, and they were in that age group, you would say, okay, well, to learn how to do it and how to run it and how to get it all done, hook up with a local handyman that has the best reputation, give him a significant amount of the work, and just watch him do his thing. And anything that he or she doesn't do, they outsource. to contractors, and your property will basically be taken care of, even if you're not a project manager, if you're not a construction guy or anything, right? Because that's, in my opinion, one of the beautiful things that came out of more fever out of the COVID time, is that people who were in construction said, okay, I don't need to work for somebody else, I can do this. And any place that I've been for handymen that are worth their dime, they can barely not ever really get them booked on anything unless you started with you,
Yeah.
then they feel an obligation. But that would be my advice to anybody, to say, okay, if I want to do house hacking, but I don't really know construction, hook up with a really good handyman and give him the majority of the work on it.
I'm going to put a little caveat to that. A friend of mine, and he hooked up in Norman, Oklahoma, with a college buddy of mine. He was probably in his early to mid 30s. He's a general contractor, major construction. He went down to Norman, Oklahoma, got a handyman down there, and said, I will make you my partner if you do all the work. Okay. I'll do the loans. I'll find the homes. I'll make you my partner. Your contribution to the partnership is the handyman and the rent collection and all that. Cause he lived in Norman and my other friend lived up in Oklahoma City. So about 25 miles apart. They crushed it. The handyman was getting all the work and 20% of the profit. My friend had a partner in the deal, and they hooked up like that. And he had, but I mean, he had 13, 14, 15 houses. And then he ended up selling them 15 years later, and all of them were paid off. All of them were paid off. And it was just a good deal. So dovetailing off of your story, it does work.
Absolutely. And
Yeah.
yeah, so just wanted to mention it because sometimes people say, yeah, I get this idea about house hacking, but how do I do it if I don't know construction? And
Yeah.
your example is a great example for that. So circling back to coming to an end for the show for today,
Yeah.
if people are thinking about, okay, I want to get in either the idea of syndication, or I like what Axel is doing with Idea Wealth Grower, how would you basically position where we are in the market right now? And you said in the write-up here, once in a decade opportunity, and we explained what that means for that part of the funding. But overall, how would you say right now, what should people consider if they consider investing in real estate?
Well, outside of the single family and the duplex and triplex, because I think the lending is a little tough for first timers on that.
Right.
But in my world, the thing that I think you should be very cautious of, especially if you're not a very experienced person, is any like new development. And even though Texas and Austin are very dynamic, we have great job growth, great migration, net migration. I mean, we're leading the nation typically in most every major category like that. We've got 2 projects on hold, okay, and we know pretty much what we're doing. We're not raising equity for those, but the opportunity, I mentioned it a little bit earlier. I think if you want to learn and get into this and be in a real safe position, for us today in our group and what we're doing with it, we have a little over 300 investors that are in our group. We're looking at this preferred equity, and there's a lot of reasons, and I'll go down the list real quick. One, we're in front of the common equity. It's a contracted return, typically 10 to 12% annualized. It's short term, so you're not going to be in something 5, 7, 10 years. You're going to be in it 2 to 3 on that. And by the way, we're underwriting them just like we would own them. And here's what I mean by that. I'm not going to go to somewhere in Missouri and start doing a deal when I don't know the market. I don't know that, because
Right.
there is a small chance we could own the project. And here's what would happen. Let's say that the market doesn't turn in the next 2 to 3 years. Then that sponsor says, look, we can't afford this project anymore. We're going to hand the keys back to the bank. We did everything we could. Right. Well, we want to, if that happens, we want to be owning that project. We don't know what's going on in Columbia, Missouri, but we know what's going on in Austin, Texas,
Right.
Dallas, Texas, Houston, Texas. So this pref equity, what it does for us is it gives us a front row seat to what's going on with that asset. And so if it's in Austin or Dallas or Houston, and we get to watch the property management company, we get to see the numbers. And I like to tell people, I said, it's kind of like a Trojan horse. Well, hang on, with an olive branch, okay? Because we're not sharks, but if we're sitting there and we're getting our return and we see that the asset's a great asset, but it's just been either mismanaged, or the common equity saying, look, we've been in this for 5 years, we just want our money back, or give us whatever. We got a seat at the table. and we're getting paid to get a seat at the table. So we're coming in and we're sitting there and we're getting paid to watch this process. I don't think we're going to pick up a lot of deals, but we may pick up 1 or 2 or 3 over the next 2 years because we're in the right place at the right time and we're getting paid to be there.
I think that makes total sense. And for the audience, you have to keep in mind when somebody's 10-year loan on a 100-unit complex comes due, I think the sequence would be to say, let's first talk to the lender and see if they can offer something. If the lender basically says, well, we cannot do much, we can give you the best rate for today, and they come in and say, okay, well, then can we get an extension and work with Darin, right? Then the bank or the lender, whoever it is, when those 2 or 3 years come to the end, are basically facing the situation to say, well, if the original operator can't do it at those rates, we have to do something, right? Because otherwise the whole thing is basically going down the drain. And I think that puts you then as somebody who is already at the table, like you just said, in a much better position than trying to find somebody else.
Yeah, the bank knows, because we the banks have to acknowledge that we're in there. And we're standing there with open arms because we've already underwrote, we know the location, we know everything. Yeah. And if we don't
probably have then the strength to say, okay, but for us, if you want to get it off your books, you will have to make a deal.
We're sitting in the right spot to take it. We are. And again, I don't want to tell people we're like doing predatorial type stuff, but we're actually coming in and we're helping, hopefully the common equity, the sponsor and the lender. But we're getting, I said it, a front row seat. We're getting paid to be there, and it's a good position to be in. So we're working on 3 of those right now, and we'll probably have a 4th one before the end of the year. And then I think by next year, I think the market's going to be a little different, and maybe there's going to be some opportunities just flat out buy some assets and do maybe a few more preferred equity deals. So I think we'll do 4 this year, maybe 4 next year, but we're going to be pretty active for the next 2 or 3 years.
Yeah, I think that's a great thing. And I mean, the little part that we're doing on our side, outside of the commercial realm, we're basically always making them 5 years just to feel like we're on the safer side. If the whole interest rate cycle takes 2 or 3, but if it takes a year longer, that's still fine, right? That's kind of like the thinking, always basically being on the safe side. Now, is that stuff that you just discussed and that you just explained, is that on Club Capital or where do
I'll tell you what, it's on clubcapital.co, not com, clubcapital.co, and then /ideal. Okay. And what we've got on there is we have a Pref Equity 101, just it goes through some definitions and terms and kind of lays out the structure. And then there's a little more detailed document on there. And then we actually have what I call a tombstone. It's just a 2-pager. It kind of gives you this is what we used to call it back when, but it gives you the highlights. That's that. But the Club Capital, just so people see this, I'm gonna put this up right here. Can you see that?
Yeah.
Clubcapital.co, and then /ideal. If they go there, we've got, I think, 3 things on that, and then our website, clubcapital.co. But we're really into education stuff, so there's a lot of good material on there that they can download just to study.
So before we close, one last question that I ask everybody is, if you could meet anybody, dead or alive, who would it be and why?
Oh, okay. I'm so glad you asked this, and I'm glad that I know you're in the Air Force. I have an uncle that was a Doolittle Raider. I don't know, do you know about the Doolittle Raiders? When we countered back after, Japan attacked Pearl Harbor, and our first counter going back over in April that following year, he was one of the Doolittle Raiders, and I have his diary. I read this diary, and I'm going like, this is cool, okay? And I just want to hear the stories behind what was going on in America then. And I guess going back, there's a lot of people I want to go see, but because he's related to me, I'd really like to sit down with him and say, tell me what you were thinking as a 23-year-old when Doolittle told you, boys, we have to launch now 400 miles before our launch position. You don't have enough fuel to get back. Good luck. And if you don't want to do the mission, then that's fine. And not one kid. And I think the oldest guy out of the whole crew, out of all the crews, I think was 28. He was considered like an old man. But you've got these 23-year-old kids that say, we're taking bombers off of an aircraft carrier, and we have to have not enough fuel to get back. I would love to hear that story.
I can tell you from my own experience that more than I think the public ever realizes, and I would believe that is still true today, is how much people that do that job are committed to the purpose of the mission. I, for example, always prided myself, even though I was always one of the either number one or second highest rank in the unit that I was in, that I never needed to point to the rank to get anything done.
Yep, it's a different time, but I mean, all of those guys and girls, I mean, there was just, we're going to get it done. We're going to teamwork, we're going to figure it out, and we're going to do it. And that mentality and that ability to execute and that discipline, man, that carries into your entire life and everything you do.
I think you and I are similar. We are so much into this and passionate about it. We can talk about it hours and hours and hours. So
yeah, we could. Yeah, we really could. We're probably, I know you're younger than me, but you're not that much younger than me. I know we can tell some stories. So
yeah, absolutely, no doubt about it.
We're gonna flip this, and I'm gonna call you. I'm gonna ask you about Air Force stuff. Okay.
Okay. Cool.
Well, awesome. Thank you. Yeah, it was a pleasure. Thank you so much. We'll talk soon.